today, and Nitin Spinners is the first management that we have on the show. The company reported a stable third quarter performance. Now to discuss the quarter gone by, where the profit surged over 39%, the margins were also healthy. The company has also announced a Capex plan of over 1100 crore rupees over the next 24 months. Now we are being joined by Dinesh Nolkha, the chairman and managing director at Nitin Spinners. Mr. Nolkha, good afternoon. Thank you so much for joining in. First, talk about your Capex plan, sir. You've announced an 1100 crore rupee Capex. What does that do to your capability? And first, if you could tell us your existing utilization levels, what does that do once the Capex comes on stream, and how does that boost your financials?
Good afternoon. Thank you for having me on the show. We have announced a Capex of about 1100 crores, which consists of an integrated spinning, weaving, and processing plant to make the fashion fabrics. So this particular will be located at one of our existing facilities in Chittorgarh district in Rajasthan. So we are adding, will be nearly doubling our capacity of the woven fabrics, which we already have. Our existing facilities are running, especially in the spinning, above 95% utilization level, and in the fabric division, it is running at the 90% plus capacity utilization. So looking into the capacity constraints, we thought of increasing the capacity, adding more products into our portfolio. We were missing certain fashion products in the portfolio, so like to add that, and accordingly have planned for this Capex. So this should basically give us a additional revenue of about 1,000 crores going forward once this is completely up and started.
All right, 1100 crore Capex in the next 24 months adds 1,000 crores to your revenue as well. Thanks a lot, Mr. Nolkha, for joining in. Always a pleasure speaking with you. In the very near term, if you could give us a sense of, how the spreads are between yarn and fiber, how is that likely to impact your margins in the very near future?
At this point of time, the spreads have been quite stable for last 2-3 quarters. As you can see, we have been running at a stable EBITDA of about in the range of 14 to 14.5%. And we expect this to remain like this. There has been, cotton prices have been continuously sliding. If you see in last 1 year, they've gone down by about 15%. And similarly, yarn prices have also gone down by nearly 8 to 10%. So now we are feeling that this is a kind of a bottom of the prices internationally as well as in India. So looking from here, we feel that the cotton prices should be stable and move slightly upwards, looking to the overall situation, and then accordingly the yarn prices should move.
So stability in cotton prices, slight up move. Your spreads would remain the same, or would you see some narrowing of the spreads? Because right now we've seen some expansion. If the yarn prices have reduced by about 8 to 10% and cotton reduced by 15%, you've seen a slight widening in spreads.
It is more or less in a similar range. Basically, cotton prices have, if you compare with last year, definitely spreads are better. But if you go with the long-term average, I think spreads are still on the lower side. So we expect this to remain like this. We have seen that some of the capacities, smaller capacities, and old equipments have also gone out of system. This has balanced the demand and supply situation at this point of time. So that has actually created a reasonable platform for the good companies.
What is the demand supply situation currently on ground, Mr. Nolkha? Because majority of your revenue comes from the export markets. But what are the trends that you are witnessing both overseas as well as in the domestic market when it comes to demand?
As far as demand is concerned, overseas, we had a very tepid last year, 2023, where the demand was substantially down. The average exports of cotton yarn from India was in the range of about 55 to 60,000 tons every month on an average basis. This has improved up to about 90,000 tons to 1 lakh ton. On the peak of it, we have gone up to 120,000 tons average also a couple of years back in 21-22. So we expect that still there will be scope of improvement going forward as well in the quantities. So that is the expectation at this point of time. We are seeing that demand is coming back slowly in international markets. European markets are also now stabilizing, as well as US is again picking up. We are seeing good demand of various kind of products, textile products in the US as well. As far as domestic is concerned, we feel domestic has been very, very stable. However, some of our garment exporters have received very good orders of late from the various international brands, and that is kicking in the demand scenario in the domestic as well.
All right, just before we speak about some more things, Mr. Nolkha, typically textiles is spoken of as one of the beneficiaries of the weakening rupee as well. So what kind of impact do you see on your financials in the very near term on account of the weakening of the rupee that we've seen? What's your hedging policy here?
We are normally fully hedged. On the revenue is being hedged normally on a weekly or a half month on a 2-week basis. So whatever the benefits of rupee weakening will come, that will accrue to us after maybe 1 or 2 months only, once as we get the new orders. So there is actually rupee was overvalued, and that was hitting our competitiveness as well. So now, once the rupee is coming to the realistic levels, we are finding that the exports is becoming better, and going forward, the margins also should improve accordingly.
All right, so then that leads me to my final question. One is on your margins, because you are increasing your capacity from the woven end of things. Now your margins are closer to 20-odd%. You've been in this 15-14% range. So with increased value contribution coming in, what are the margins likely to be here? And the second part, you've taken on some debt as well. Last known debt was close to 1250 crores. Additional 800 crores for this Capex brings your balance sheet to a debt of 2000 crores. So when do you plan to, repay this debt? What could your peak finance costs be as well? So on margins and peak debt repayment plans.
Let me first address your second question. Wherein about the debts, we are regularly paying off our debts. About 175 crores of repayment is there every year. Since all these debt which we have taken is under concessional interest rates, so we do not want to prepone some of these repayments. Once after 2 years, when our Capex will be completed, our total debt to our equity will be in the range, including our working capital debt, will be in the range of about 1.15 levels, which is same as what it was in the year 2024. So this is as per our stated policy itself. Our long-term debts are nearly at 0.75 to our total net worth. So that augurs pretty well in comparison to in this industry, in textile industry. As far as the margins are concerned, definitely the new expansion which we are taking is will be margin accretive, because it's a completely integrated plant. So it will be margin accretive to our existing margins. Since this is a cyclical industry, and we have various kinds of issues, geopolitical issues, as well as the domestic government regulatory policies which affects our margins, we feel that given in the similar conditions, our new expansion will add to about 150 to 200 bips to our existing portfolio, existing profile itself.
That's the answer that we were looking for, Mr. Nolkha. Thank you so much for sparing time and joining us today. Wish you good luck for the expansion plans and for the road ahead as well. The management of Nitin Spinners expecting 1,000 crore revenue addition post this new capacity expansion, and 150 to 200 bips on the margins. And you can see the impact on the stock price as well. At the highest point of the day now is Nitin Spinners at 377. Take a short break, but before